Tech and AI stocks powered the markets last year, but with high valuations and growing concerns about an AI bubble, questions remain about their performance this year. We have Jamie Murray, president of the Murray Wealth Group, to unpack this, along with the Venezuelan oil situation and upcoming earnings. A lot to unpack here this morning. Good morning. Thanks so much for joining us.
Thanks for having me.
Let's start with the big newsmaker of the day, which has been making news all weekends. That's the capture of Nicolas Maduro from Venezuela. We're seeing the markets and commodities reacting to this today. What are you watching and what's kind of standing out to you the most in relation to that?
Yeah, there's certainly lots of varying opinions on the capture and what the future course of action the U.S. government will take with Venezuela. What we're watching right now is actually the FX rate, the Canadian U.S. dollar exchange rate, because I think that, at least in terms of Canadian equities and Canadian oil stocks, is going to be a big driver of how concerned the market is for Canadian crude. And as you just showed it, it's off a little bit today. So I mean, there's a bit of a reaction. We're also seeing the big Canadian oil sands companies down about 2 or 3%. And I mean, I just think that reflects a new downside case if Venezuela is able to bring on a lot of oil over the next, call it 24 to 36 months. But there's certainly still tons of uncertainty. The next 30 to 60 days are going to hopefully reveal a little bit more information. But there is a world where this production can come back on stream if the U.S. government makes a very concerted effort. Likely would involve, I think, military personnel in the area from the U.S. government. But if we're just going to be status quo and just taking one guy out of the equation and keeping the rest intact, I think there's a lot of variables that would make it very hard for Venezuela to meaningfully ramp up oil production over the coming decade.
Well, that was going to be my next, over the coming decade, because as you talked about, like there's an expectation here from some that maybe we could see that oil production ramp up in the next 24 months or so. Like, how realistic is a time frame like that? You sound as though you think it might take longer, obviously.
Yeah, I do. So, I mean, I think in a perfect scenario with unfettered access to Venezuela, I think 24 to 36 months is what it would take. But I think there's going to be a lot of issues and headwinds that stand in the way. I mean, number one is, are you going to have cooperative government and even just factions within Venezuela, like guerrilla warfare tactics could, blowing up pipelines or disturbing wells could slow this down meaningfully, just that alone. So just a small subset of people could slow this down. But then there's the billions of dollars of capital you need. It's not just drilling new wells, it's building new pipelines. Venezuela has very, very heavy, hard to produce oil, requires a ton of power. And so you're going to need to rebuild the power infrastructure in Venezuela. And we're seeing, in the US, it's hard to find power and equipment, even engineers and electricians to do that. So a lot of technical aspects that is going to make this a hard ramp, I think.
And just before we move on to other things on oil, could what we're seeing happening right now with Venezuela hurt Canada's position, I guess, when it comes to oil in the U.S. market?
And so it could. So that's where it comes up to this ramp up of oil production. I mean, certainly, even just a 30 to 40% increase in Venezuelan oil production, $300,000, $400,000 barrels a day could start to make an impact in the differential that Canada oil trades at with global markets. And so that's why, I mean, I think it is going to be important to get that pipeline built out to Tidewater. But, there is another scenario where we're seeing oil prices actually up today. Like I said, if this transition period or in the next 30 to 60 days, we see a lot of resistance from within Venezuela to the U.S. involvement, we could actually see, oil prices strengthen, some more geopolitical risk, and Canada is still this great energy secure, friendly country to buy and get your oil from. So we'll have to see how this ultimately plays out. But I would be probably buying the Canadian oil stocks on this 3 to 4% dip that we're seeing versus selling them.
Interesting. Okay, yeah, we'll have to keep an eye on what's happening there. Let's move on now to other things you're watching for in the market now that we're into 2026. Tech stocks. So are we setting up for another breakthrough when it comes to AI tech stocks in 2026, do you think?
Yeah, we think so. So we're long the mega cap stocks, Amazon, Alphabet, Microsoft. We own some Meta as well. And we also do like the semiconductor companies, particularly NVIDIA and Broadcom. On those two companies, we've seen their revenue estimates continue to accelerate for 2026 through 2028, just over the last 3 or 4 months. So you haven't seen the stock prices of those two companies move up too much. in the last 6 months. But the revenue and earnings in the coming decade are moving up quite substantially. And NVIDIA particularly is interesting. They're right at the start of this NV72 super cycle. So this is their new chip. It combines 72 NVIDIA GPUs. It's a much more powerful unit. And so we're seeing just today, Foxconn, one of the companies that puts these racks together for NVIDIA, seeing accelerating orders and shipments. And so, that bodes well for NVIDIA, we think, this year. And ultimately, then we're looking for new, I don't know if breakthrough is the right word, but just more products, more productive, better AI models. We saw a big jump in the last 18 months in AI models. And now as we get even better and better models, we're going to see enterprise adoption start to accelerate. So companies actually building AI into their core businesses and into their core products, which is just going to continue to increase usage exponentially.
And just lastly, you're also watching the shares of Aritzia today as well, set to surprise to the upside possibly when they report earnings later this week. What are you watching for when it comes to Aritzia, and what are you seeing today?
Yeah, so Aritzia has been one of our long-term holds in Canada. Just a phenomenally well-run company. Had a great 2025, obviously up over 100%. So that does lead to questions. What is the upside from here? Well, when we look at some credit card data, when we look at other available public data, it seems like the company's still firing all cylinders. I think there's lots of upside to their revenue forecast for the quarter that they're going to report on Thursday and into 2026. And so as long as we keep seeing that upside to sales, we think the stock's going to continue to move higher. And ultimately, you're holding and owning Aritzia because you see, not just U.S. expansion, but eventually global expansion. You see this becoming a global brand like a Lululemon, like Zara. These companies have market caps double, triple, quadruple what Aritzia is. And so that's the play that you're holding Aritzia for.
Yeah, I wanted to ask you about that quickly because, of course, we're seeing Aritzia expand into the U.S., particularly this year. That's the plan, to open more stores there. But as you mentioned, international launch likely in a couple of years from now. Just how much more do you think this stock can really go up?
Yeah, we think it's going to grow revenue about 20% per year, we think, over the next 3 years. And so that's sort of our guidepost right there. If we can get another 25, 30% in 2026, we'd be obviously super happy with Aritzia. And just with the international expansion, why we're more encouraged by it is we're seeing them build these giant flagship stores. So they built a few in New York City. There's obviously here in Canada, there's a big one at Yorkdale Mall. They're taking over half of the Eaton Center, it seems. Here in Toronto and Vancouver, a big store. But they're putting in these big 40,000 square foot locations, and that acts as both a digital billboard, a physical billboard, and helps them with their digital sales. So if you think internationally, moving into a city like Melbourne, like London, Hong Kong, you can open one large location and get a whole lot of brand equity in that country.
Okay, lots to watch for. That's all the time we have, though, right now. Jamie Murray, president of the Murray Wealth Group, joining us. Thanks so much for your time. Appreciate it.
Yeah, thanks, Lindsay.